Hello, everybody. Happy weekend. Tim Knight here. You may be puzzled at the enormous number of videos promised this weekend. To explain, I have a lot of short positions right now, and I confess in my mind, I usually think to myself, "All right, well, let's go back to elementary school. The factors, what number times what number would equal how many shorts I've got." I just like to break things up even. It's one of my many oddities. Anyway, with 84 different shorts, it occurred to me, well, what I could do is make it in sets of three instead of sets of two. Because as most of you know, I usually have half for everybody and half just for gold and diamond. This time, I'm going to have three different sets. Videos 1 through 12. A third of them will be for everybody. A third of them will be for all paying members, including bronze and silver. And a third, traditionally, will go to my beloved gold and diamond members. So that's why so many. And they're going to be a little fun size, as I put in the subject line. Just 7 symbols each. If I've done my math, 7 times 12 should equal the total number of shorts. But I know that if I just show images, it's quicker. You can just kind of scan it. I know videos take a little longer, a little more commitment on your part. But it gives me the opportunity to add a lot more color than just like having a static picture without my mellifluous voice stacked on top. So that's why. So this is video 0 because I didn't want to show you any shorts. I just wanted to talk a little bit about the market in general because we had a weird and harrowing week and a very harrowing April. Let's just talk, good heavens, if I can click my mouse properly, about indexes. Okay, so here's the Dow Jones Composite. Now, the long-term channel, not super long-term, because some of them do have that, but it goes back 11 years. That was broken with quite a bit of gusto back on March 6th. And we fell and fell and fell, and regrettably, went exploding higher. And I say regrettably, but the truth is that you know how much I was whining about not making the most of the initial fall. Maybe I should stop belly aching. This could be a second bite at the apple that we're so rarely granted in life. So I'll try to stop complaining. But we got as high as here, 8071.71. In a lot of cases, the Fibonacci's aren't squeaky clean, so I'm not bothering showing those. There's no super clean 50% levels, etc. Tend to be a little messier than that. Indeed, the bounce point doesn't really align perfectly to anything. It's not exactly at the bottom of the trend line. It's not exactly at a big price gap or anything of that sort. I'm merely anchoring these high prices to the highs we saw on Wednesday, which is where the darling Jerome Powell did his thing, and the market peaked, as it so often does weirdly on the days when he comes out to do his thing. So that's where we're at. And a lot of charts, as you imagine, look just like that. Here's the NASDAQ Composite. It too broke a long-term trend line, but it not for long. And unlike the comp, it's way above it again. And it has come a lot farther back. I remember, like it was hours and hours ago. On Wednesday, we were a mere 6% below the highest points in human history on NASDAQ. So very little damage. But we have bounced firmly, and we shall see if we can give up the ghost from these levels. The one I've been particularly obsessed with is the Russell. Now, the Russell's a curious creature. Back in the financial crisis, it had one of the cleanest tops ever offered the chartists of the world. You can see right here, it's just absolutely gorgeous, and fell magnificently afterward. I'm just fine-tuning it here a little bit. So there was that. This one's a little tougher to read because we had a diamond pattern, and that was, now we can look back and see that was sort of the last gasp of the bull market, because that diamond pattern gave it a couple or 3 months of gasoline left to go higher, and it peaked and didn't even reach a lifetime high. Funny enough, the lifetime high was way back in the middle of 2018, but we tried to reach another high, and then of course we had this glorious collapse right here. and went roaring back. Now, this one did feature a very important price gap between March 6 and 9, dates that are showing up constantly because that was such a big weekend. We almost got back there on Wednesday, then we're starting to retreat. But this looks like it seemed completely plausible that the Fed-induced bounce on here may have exhausted itself. I should certainly hope so. Now, the S&P does, in fact, have kind of an interesting Fibonacci, and I actually think I'll end this video with this one. Now, I'm a very honest chartist. I don't like pulling the wool over people's eyes with charts. It ain't right, and I'm known for my earnest nature. I don't want to wreck that. So I'm telling you that this is not your typical retracement because it is anchored to a very queer point right here. The upper anchor makes total sense because that's the lifetime high. The lower anchor is just kind of floating in the middle of nowhere. This is kind of a shameless form of backfitting, if you will. But the reason I'm being the naughty chartist here is because I do find it kind of interesting how the relationship with these levels interacts with the prices, even though there is nothing particularly significant about November 2012. It just so happens that, if you look at these lines and observe their importance with respect to support and resistance, I find them engaging. It may just be crazy random chance, I don't know, but I've left them there just because they caught my fancy. As it is now, I will mention that Wednesday's high was 2954.86, and this retracement is at 2954.78. So a ghastly small spread between those two. So with all that caveat, I just wanted to mention that. And even without that, of course, it's an interesting setup because we've got this channel, which we've mushed into again. But having broken it, we're back up here. And of course, what I desperately want to see is resumption of this fall. Apropos of nothing, I just want to say one last thing. I did not plan on saying this. I've kind of teased and picked on the boys down in Gainesville, the Elliott Wave crew, over the years. But I'll say something I've said rarely before, but it bears repeating. In my experience, I have found that the whole Elliott Wave thing actually works surprisingly well during bear markets. During the bull run, it became kind of a running joke. But my experience in 2007 and 2009, I became virtually a religious convert because I was stunned how well it all worked out. This is probably largely wishful thinking on my part. A data point of 1 is not significant. But that multi-year experience did impress me and was eroded badly by the whole bull market. But now that a bear market is apparently upon us again, I must say that I've been kind of impressed. The wishful thinking part comes simply from the fact that what they are projecting is absolutely apocalyptic in its scope. So we will see how that works out. In any case, I've got 12 videos to do now, and I shall proceed to do them, and you'll see those tumbling into your browser real soon now. So I better get to work.